Hey guys, this is Bruce Marshall from Simpler Trading with the nightly video update for Wednesday, August the 14th. And it may just be me, but it seems like every time when I do an update, we have a really crazy day in the market today. And that is what happened today. The Dow went down 800 points. The S&P is down 96, and the Nasdaq's down 265 or so, something like that. Bad day, right? And the problem you know from the point of today is that we dropped and dropped and dropped and dropped and dropped, and we had one slight little bounce, and that was it. And that was very very wimpy. Now we did come right back down and test this level, over and over and over and over and over and over and over again, and it held, kinda, sorta. it 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 fell after the market a little bit more, but the problem is I've got a tick chart here. This is an NYSE tick chart, and when you get the tick charts, I've got a mark here or an alert to go off at 700. That means strong buying. So we have strong buying, strong selling, strong buying, strong selling, buying, selling, buying, selling. We just complete chop here into the end of the day today. Normally you will break out one with the other, but you can visibly see it right here. We just went nowhere, and that's probably a function of maybe shorts getting scared and trying to close, and then people that aren't short are trying to get short into the market, so you have a bunch of congestion right there, and nothing really happens. But the thing about that is it's never good to go out on the low of the day like this. But let's kind of put this in perspective. Let me pull this down and do a little more detective work here. So we know yesterday that we had this huge run higher here. We were up 62 or something like that on the S&P. Ripped higher, crazy move higher. This was on some of the tariffs being lifted on the China trade maneuvers or trade concerns, trade war, whatever you want to call it, going on. So great news, and then we just kind of went flat. All the euphoria was out, and we kind of went flat. And then overnight, the yield curve inverted, and people get when the yield curve, people think, or everyone, if you ask 100 people, 99 people would say every time the yield curve inverts, you get a recession. Yeah, maybe not. First of all, it's not. It's not guaranteed that that's going to happen. It implies chances are higher, right? But the average time from the yield curve inversion to any kind of recession starting is about 15 months. So it's not like it's going to happen next week. And on a economic basis in the United States right now, the data is still good. The problem is global markets are slowing down. Everybody knows that. We got trouble in places around the world, growth rates and so forth that will ultimately affect us. But does that mean we're going to crash here? And I think this is maybe overdone. Let's back this out a little bit, and we'll see. So I talked about this last week, and in the video, if you caught my video last week, I said that in a lot of cases when you get an extreme sell-off like this, and then you get an extreme rally, that it's given back. And I pointed to that and that and that and, well, perhaps this. Anyway, so this shouldn't really be a big surprise. We all know this is just, we're in a hypersensitive news driven market. China, the Fed, currency, what's going on with the dollar, what's going on with the yen, so forth. So, how is this going to resolve itself? And ultimately, I think, it will be higher. Because the Fed will step in. The Fed's going to step in. There's a meeting in Jackson Hole next week. And while I don't think they'll do anything at that meeting, it's on the 22nd through the 24th, the Jackson Hole Symposium. The Fed can make a policy adjustment anytime. They don't have to wait to a Fed meeting. Now, the actual Fed meeting is September 18th, but people are already anticipating bigger rate cut, more or series of smaller rate cuts. The Fed's going to come in and save us, and we know that when the Fed comes in and save us, that's there and that's there. It's exactly what's kind of sparked this, right? That probably will happen again. We probably get a 50 basis point cut versus a 25, and then we get a big, nice move up. But the problem is, how far down do we go prior to that happen? And I should have mentioned, I'm just talking about the S&P. So if you notice here, this is our 200-day moving average, and that is the prior high that I think we have a pretty good chance of coming down. This might hold. This retesting this level should hold. And then I've actually got another level down here at 2650 that is a what's called a voodoo line. So, the bottom line, we could get, we've had 3 out of the 4 days have been down. We could get a bounce tomorrow, and or Friday that might be sold into. So I think it's not, at this point, we don't need to be worrying about 3,100 or 2,600. We need to be worried about, are we going to come back up here, or are we going to come down here, in the next week or so. Unfortunately, that that kind of puts us on the sidelines, and I remain extremely light. I think I told you guys I got flat ahead of the Fed meeting, and have just had just very, very few trades, and they've been pretty small. And everything's working out so far, but I don't want to short this market down here at this level. I would rather just stay in cash. If we do get a pretty decent bounce on just short covering, or not a news driven bounce. If the Fed comes in and cuts rates and we start ripping higher, don't short that. But if we just bounce because we're oversold and we get short covering, that type thing, I probably would actually try to lightly short that back down to some of these levels we were talking about. Otherwise, I'm just going to kind of sit and wait and watch. I think that makes the most sense. Unfortunately, and at the same time, we look for kind of honey badger stocks that don't care what the market is doing, such as Procter & Gamble. That chart looks fine, right? Starbucks, that chart looks fine. There are stocks out there. McDonald's looks fine, So try to focus on those type stocks, and be careful with the others, trying to, buy the dip on some of these, because the dip may go a lot lower. And I wish I had a little more clarity for you, but normally, on, like, for example, on the S&P, we're looking at tighter ranges at any point in time. When we're looking back here now, instead of a normal expected move tight range, 37 to 45 points, something like that, we're looking at 100 up, 100 down, and that would still be reasonable, probably. So, as they say, be careful out there. Stay light, stay nimble. I feel like I'm always saying that, but that's what we've been trading in lately. So just be careful. Try to pick the honey badgers if you really want to get in this, but be really careful of trying to catch the falling knife, and catch some of these stocks that are sold off, because they can go lower. There will be a time to jump in and buy some of those. I don't think that time's yet, unfortunately. So with that, I'll wind it up. I hope this was helpful. Kind of keep those dates in mind with the Fed next week, with the Fed on September 18th, and watch the news for, of course, what's going on in the bond market, the yield curve, and of course news out of China and that type thing. So that's what we've got right now. So be careful, and I will see you guys at the next update. Thanks a lot. Take care.